Good morning and welcome to the Real Estate Chicas Talk Show. I'm Jen Olmstead, and with me today,
I'm Ana Montemayor. Hola, buenos días.
And our special guest is Laura Gilrow. She's with Homestead Funding. Hi, Laura.
Good morning, everyone. Nice to be here.
Yeah, on this nice, icy, snowy day. So today we are going to talk about how to increase your credit score, things you can do to get pre-approved. As we're heading into the new year, a lot of people have made it a goal to purchase a home, and we're going to give you some tips and tricks on how to get yourself ready so that you're in the best position when it comes time to get pre-approved. Laura is with Homestead Funding, and do you want to tell us a little bit about yourself?
Sure. Good morning again. I am Laura Gilrow. I have been in the mortgage business for just about 30 years now, and I've been with Homestead Funding going on, I believe, 12 years with Homestead Funding. Specialize in rehab loans as well as construction loans.
Great. And Anna and myself are with Homestead Real Estate Group. We help buyers and sellers with their home purchasing and selling needs. So if you ever need anything or have any questions, feel free to reach out to any one of us. We'd be happy to answer any of your questions.
Yep. Buenos días a todos. Aquí estamos en nuestro Real Estate Chicas Show y tenemos a Laura Gilrow de Homestead Funding con nosotros. Y bueno, vamos a platicar acerca de créditos, it's my mom's cuckoo.
That's your mom's cuckoo clock?
Some of the things that we gotta deal with it when we're live. Y bueno, vamos a hablar acerca de créditos, las metas de este 2022. Quien quiera comprar una casa, esa es una excelente información para ustedes. So thank you very much, Laura, for being here and answering all our questions and helping everyone.
My pleasure.
The first thing I want to talk about is a lot of times people will come to me, they're not pre-approved. They'll tell me that they checked out Credit Karma, and they'll tell me approximately what their credit score is. Then what will happen is I'll send them to a mortgage company, and they'll find out that their credit score is actually lower than what they thought it was. Laura, what can you tell us about the different credit bureaus?
And so what Homestead does is we pull true credit scores. We pull credit through Experian, Equifax, and TransUnion. Credit Karma, as you mentioned, Jan, you're absolutely right. I run into the same situations where I'm working with a client, and they're telling me that they went to Credit Karma, and their credit score is, let's say a 700, and it turns out their credit score can potentially really be around a 650. So obviously, the first thing I do is, I'll say, can I pull your credit? Homestead Funding does have the ability to do a soft pull pre-qualification credit report so that we know exactly where that score is when we're entering into a transaction with a client.
And realistically, let's talk about credit score. What does somebody want or need for a credit score in order to be approved for a mortgage?
So Homestead Funding will go down to a 620 credit score.
Okay. Now, how does that impact the product that they qualify for?
Well, obviously, the better your credit score, the better your interest rate. FHAs, sometimes we have clients that are down to a 620, but, obviously compensating factors are going to help. If they have more money down, if they have additional reserves in their bank account, everything is relative based on a credit score. As I mentioned, the higher the credit score, the better the interest rate.
And what about when a client doesn't meet that requirement? Can you offer some strategies to the person to get it higher?
Yes. So we do have a company that we do work with. It's called Credit Evolve. If I feel the customer might need a little assistance, I may connect it to. Otherwise, I'll try to give them some good pointers. Basically, obviously the biggest thing is, don't have any late payments on your credit cards. Try to keep everything current, especially within the last 6 to 12 months. 12 months is key. The longer you have a credit card out, and the cleaner it is, the better position you'll be in for purchasing a home with your credit scores.
I find a lot of times too, buyers will come to me saying they're assuming they have good credit because the only credit they have is a car payment. And then they're surprised that they're told they don't have enough credit. What are some things you suggest? So if somebody's out there and they said, oh, I'm sure I have good credit. All I have is a car loan. I don't have any student loans. I don't have any credit cards. I pay everything out of my pocket. I should be good to go. Then they're surprised to find out that they actually don't have enough credit. What are some tips and tricks that you can suggest for that? Or what do you usually tell people?
Sure, absolutely. So I typically will tell the client, try to become an authorized user on a credit card, maybe a parent, a relative's credit card. Make sure that obviously that they're paying their bills on time. It's always key. But become an authorized user, or try and take out a secured credit card. They offer secured credit cards out there where you can just have a balance, very small balance, and you're building up your credit. Also, to try to get some smaller credit cards at some of the local stores, Walmart, Kohl's, Boscov's, try to get some
credit cards are okay for building credit.
Yes.
Is there a certain amount that they should be spending on that credit card, and should they be paying that off every month?
So they should not be paying it off every month. It's always smart to keep a say like you have a credit card that has a $500 limit. Try to keep your balances anywhere between 10 and 30% of that maximum limit. It'll definitely increase your credit scores.
What's the logic behind that? Why should we keep it like that?
It's basically based on quote unquote usury and how much you're using your credit cards. So it's not smart to pay everything off each month. Always keep a small balance.
Which is like crazy to think, because the mindset that you have is you pay off the people that you're owed and things like that. So to be told you have to go spend money to be able to build credit and to keep that line open is really surprising. Yes. Another interesting fact that I find is that they don't suggest, once you pay off a credit card, don't close that credit. Keep it open.
Correct. Do not close your credit cards. It actually hurts more than it helps.
Yep. I had a case that I want to share here, because maybe some of the people who is listening could relate with it. So what if I'm a very good person and I help people around me, and I gave them loans under my name, right? And now I want to buy a house. That might affect my credit score, because I help a lot of people, relatives or whatever, and those are not my debts. If I'm in that situation, how can I help me to get my loan?
So if you're trying to buy a house and you have co-signed,
yes,
on a home or
or car, loan,
car, yeah. But basically, what they're going to need to do is they're going to need to refinance that loan in their own name. They're going to have to credit qualify on their own. And I'll elaborate some more here. Parents are always willing to co-sign for their child if they can. And I just always try to give them the spiel that, you're a co-signer. You are going to be required. That's going to be a responsibility of you to make sure that payment is made each month as well. It's, because it could, if the payments aren't made, it can hurt you. And obviously, if you're trying to purchase something else, that debt's going to be counted against you as well, and your debt to income qualifying ratios.
And debt to income is really important, because even if the payments are made on time, that debt, which isn't your debt, is going towards what they're looking at in terms of expenses that you're paying monthly or responsible for against what you're making.
Correct.
So that's really where you see that more as a impact, is your debt to income ratio, making it so that you have more credit than the threshold. What's the threshold right now for debt to income?
So debt to income is all going to depend on credit scores with regards to FHA. So homestead funding, if you have a credit score at 660, we'll go up to a 55 debt to income ratio. With our conventional, excuse me?
For FHA, right?
FHA, correct. For our conventional loans, it's all going to be credit related. Typically, we want to stay up at a 45, but if a customer has plenty of reserves, very good good credit score, great reserves, sometimes we'll be able to go up to a back ratio of a 49.
Great.
Yeah.
So what about if somebody has that, will you tell them to dip into the reserves to actually pay off certain credits and things like that over putting it towards a down payment?
What I'll typically do is I'll look at the whole picture. I just had a client recently where, they have a 700 credit score. And I was able to structure it where I was still able to do 100% financing for them. And they just had I'm talking a VA, and I just asked them to pay off a very small debt to qualify. So I was able, because most clients, if you're able to do 100% financing, they want to take advantage of that. So if there's a small debt, $500 that you can pay off, by all means, we're going to go that route.
Great. Is there situations, what would you say timeline wise? Are there situations where somebody is like softly pre-approved, provided that they get those things done ASAP? Or is it like, hey, get these done and let's wait 6 months? What's that kind of timeline look like if somebody's trying to repair or build their credit?
So, I try to be as open and honest with people because, if your especially first time home buyers, you don't want to discourage them, and they're happy when you say, hey, listen, this is what you need to do. I can either, connect them with the credit evolve company that we work with, or I can kind of give them some basics. If their scores are lacking, I'll say, let's take a look at your report. Let's see what we need to work on. Obviously, if there's high balances, let's get those balances paid down. If there's some larger, older, collections, let's work on seeing what we can do to get those taken care of. So I try to be upfront and honest with especially in first time home buyers. You don't want to discourage them. So you try to give them as much information up front. And at the end of the day, they're very appreciative that we can at least put them into a time frame and say, you know what, let's talk again in 6 months. Let's talk again in 12 months.
Right.
Great.
Yeah. So what are other requirements that we need to know when it's to applying for a loan, for example, besides the credit score?
So a few things you should know is obviously, your employment, it's always good to have you always need to have a 2-year history, whether it's especially if it's in the same line of work. That's great. As far as your cash to close, make sure that your money that you're using for closing is in a bank account. Yes, you can get gifts. Yes, you can take money out of your 401k. We'll ask all those questions up front. Just, as far as, preparing for your closing, preparing for your application, having all your ducks in a row, just make sure that you have you're keeping track of all your pay stubs and your bank statements, keeping track of any reserves that you might be able to use, and obviously making sure you pay your debts on time each month when you're preparing for application.
So regarding to the job that you were mentioning, you need to have 2 years, right, of in the same line of work at least. What happened now? I have found some people that because of COVID, they couldn't work or they got laid off for 1 year, and now they are back on track again. But they don't have yet the 2 years. So can they still apply, or what's the case?
They can still apply, and each scenario is going to have a different different case. So basically, I run into a situation, and let me back up for a minute. So with the 2-year history, if a child or a person is graduating college, we see a degree, and then they start work, we can absolutely assist with a mortgage then as well, and or if they've had some did some type of training, skill training, we can work with them that way too. Now, as far as the 2-year history and the COVID situation, everything is relative. We have to look at the whole picture, because if someone's been out of work for about a year and they're starting work again, we're probably going to want to see that they're back on their job for at least 6 months to a year. We've been running into that a lot lately, with this whole COVID. Try to just give our customers the best advice. Please, stay on your job. Call me in 6 months. Let's relook at the picture. And if we need to go at least 12 months out, then we'll go 12 months out. But we're going to want to have all the specifics. What I typically will do too is have someone, put together an employment history for me, very detailed, so that I can go to an underwriter and have them review it.
Great. One important detail that I think a lot of people don't realize too is child support. I cannot tell you how many times we have gone into the process of buying a home and the person never mentioned that they are paying child support, which is a huge part of determining your debt to income ratios and what you get pre-approved for a loan. Those type of things will come up when they go and they check all of your finances and what is it, your tax records? Is that where that shows up, Laura?
Typically, your child support can show right up on your, especially if it comes right out of your paycheck, it can come right on your pay stub. So, people, obviously at the end of the day, just be open and honest and upfront with everything with regards to a mortgage. The more you tell us upfront, the better we can structure your loan. When we have surprises, that's when everyone gets caught off guard. And then all of a sudden it's like, what do you do now? Right. Obviously, we're going to do whatever we can to make it work. But if you pay child support, always tell your loan officer, share that information so that we can properly structure your loan.
Now, then they're going to count that into your debt to income, correct?
Correct. So let me also add this. If you're receiving child support, we want to see proof that you've been receiving it for at least 12 months. And then we're also going to see that it's going to continue for at least 3 years.
Great.
How do you prove that? Typically, we get a copy of, obviously, the divorce decree, the child support agreement, and then possibly the children's birth certificates.
Okay.
So what happened when I don't meet the requirements? What's next? Do I get or do I keep going?
So if you don't, and this has happened, over the last couple of weeks, I'll say a few clients have called me up and, first of all, they may not meet their, the credit score. So try to give them some coaching, which can be the best, if I can look at it and be as efficient with my information, I'll go that route. They can also, I can also connect them with some people that we work with regards to income. If they don't qualify, I'll say, how long you've been on your job. If you only been there a short term, maybe getting your foot in the door. And I'm sure that once you're in the door for, 6 months a year, you're going to start getting some raises to increase your income. And then obviously at the end of the day, also try to coach them on their reserves to make sure that there's no large deposits and that the money that's coming in is either from, an IRS tax return and or their salary.
One of the things I can't stress enough, though, is, people think if I get pre-approved right now that I'm buying a house in a month or so. That is not the case. Right now, with no inventory, multiple offers and things like that, it might take a few months for you to find your house. And then start to finish right now, especially because of COVID, if we're lucky, we're closing houses in 60 days. That's still 2 additional months. So let's say it takes 2 months to find your house. Your offer gets accepted. Now, if everything goes great with title, we're 2 months. We really, right now, if you were to start looking, there's a good chance you're 4 or 5 months out from actually moving into your home. So, there's not a lot of time in terms of if somebody says, oh, I'm going to buy in the spring. I'm looking at June. Realistically, now is the time. Or I just met somebody yesterday. Their lease is up May 31st. And I let them know we really need to be locked into something by February to ensure that we could be out by the time be closed by the time that you need to be out of your lease. I can't tell you how many times people come to me 3 months before their lease is up. And now we find that they have to extend by a month or 2, which costs more money on the back end of their rental, just so that they can have a place to stay while they're waiting for their house to close. So the nice thing is that if there are little blemishes on your credit, you could be working on it and still actively looking for a house right now, because it is going to take some time to get to that final point of closing on your home.
Right.
So,
correct.
Well, I love success stories. Do you have any case that you have experienced during your career that it was hard at the beginning and then you stood with them and
absolutely. Matter of fact, I have a gentleman. I want to say he was here from a different country. His credit scores weren't the best. I connected him with this credit company that we work with, and he right away listened to what I told him to do, took my advice, and within 6 months, I was able to give him a loan, and he actually closed. I want to say probably about it's been about 30 to 45 days he closed. As a matter of fact, I just heard from him the other day. He had some questions about his payment and such, but he did exactly what I told him to do. With his credit, I told him about saving his money, his employment. We had to document. He had some different jobs in the past, but he was able to document everything accordingly. And he is ecstatic that he's now in a home with his family.
Wow.
Now, something important to mention, though. So we just told you all the things to do to get ready to get pre-approved for a loan, whether it's opening up credit, paying down credit, whatever it may be. The number one thing that could be a deal killer once you're under contract is opening up more credit, closing down your credit, buying a car, things like that. So once you get pre-approved and they say your credit is exactly where you need to be to qualify for a loan, don't change it. Don't do anything major. Don't shut down your credit lines. Don't pay off. Don't buy a car. Don't go and finance your furniture. Don't do anything that's going to cause any sort of disruption in what those numbers are. The bank will do a final check at the end and will want to make sure that it stayed consistent from start to finish. Those will be major red flags and it will make it very difficult. Sometimes, I mean, we've been in situations where people have done that. They didn't say anything. They went out and bought a motorcycle because the weather's nice. You know, the COVID RV purchase, that's also been a really popular one the past couple of years. Don't go and do anything major. Once we get you to that point that you do pre-approve for a loan, just keep it consistent. Stay there. Go ahead.
What about if that mistake was made and I didn't know and I got pre-approved and then I want to buy a new car? What happened now?
Typically, you know, what's funny is I've got to the point now where my customers, I just stress to them, do not buy anything while you're buying a house. Do not do anything to deter your credit. Customers call me up now. It's funny. One of my clients recently just told me a story that I had no idea. When he was buying his house, his daughter came to him and said, "Dad, I need you to co-sign on my student loan." He's like, I can't. I can't. There's nothing I can do. He said it was a tough thing for him to tell his daughter no, but he said, "Laura told me I can't do anything to deter my credit. I can't co-sign. I had to keep everything the same." And he just told me this story. I'm like, "Oh, I didn't know that." He goes, "Yeah." He goes, "But I listened to you." I said, you listened. And, you know, sometimes people listen, sometimes people don't. I had a client recently, I had asked them they had to pay off all their debt to qualify. And some time had passed and their credit expired. We had to re-pull their credit. Turns out they paid off their debt, but then they maxed out their credit cards again. So you got to keep everything consistent. Do not do anything until that closing is done and the loan is funded. Do not do anything. Keep everything the same.
What I will say is Laura is a miracle worker and she's definitely done some great things, but there are certain things like purchase. If your debt to income ratio is extremely close to that line and you go and add to your credit, it could be a deal killer. We've had deals fall apart because the loan will get denied and then now there's just no options. So when things like that happen, sometimes there's nothing you can do. It's completely out of your hands. So, you know, when going to your loan officer, if you had a question, going to your loan officer and saying, "Hey, this is what I'm thinking about doing. What do you think?" Running it by them ahead of time is not a bad idea. Or, you know, coming to us or asking those questions up front because it is such a sensitive area and they do check one more time. I mean, we're talking about for most people, it's a 6-figure loan that a bank is willing to give you and trust in good faith that you're going to pay them back. If they see that you're racking up all this credit and you're not, you know, delegating properly, it's something that's going to become a concern for the underwriters. So sometimes it can be fixed and sometimes it can't. So might as well just get to where you need to be to get pre-approved and then just sit tight, stay consistent, keep up on your payments. Sometimes when people will have a late payment come in, now they've done great this whole time. Like Laura said, they have to do an updated pre-qual, and now boom, they get hit with a payment that they made that was late. How does that impact your credit score?
It's all going to depend on the rest of their credit history. Some people, it doesn't have that much impact, but some people it can. And then what we'll tell them to do is, get that, if the payment hasn't been made, it's 30 days late, and they have get that payment made ASAP.
What's the status on medical bills? A lot of people have come to me and they say, I have a lot of medical bill debt. And I know that, is that debt looked at differently?
Yes.
Okay.
Yeah. Most of the time with our investors, we are able to we just take it off the credit. We take it off their debt to income. We don't qualify it. When you get over certain thresholds with balances, that's when things can change. And then we try to qualify them with different percentages. But at the end of the day, medical payments, $500 payment, a $500 collection account, it's not going to have a big impact on your credit qualifying.
Okay, good to know, because a lot of people think, oh, I have a lot of medical debt, I can't qualify, and it's actually quite the opposite.
Yeah.
That's okay. Now, what about student loan debt? That's another one that's coming up.
Yep. So student loan, I was going to bring that up. So Fannie Mae. So we just had some of our investors come back to us. Typically, with an FHA loan, we had to use 1% of the balance to qualify you. Now we're able to use 50% of the balance to 0.50 to qualify you for your mortgage. So basically, that's for conventional financing. I'm sorry, FHA financing. For our conventional financing, we have two different scenarios. We can use one for Fannie, which is 1% of the balance, and then for Freddie, it's 0.5% of the balance. And then for VA financing, it's actually 50% of the balance divided by 12. So there's some different calculations we can use. And obviously, you have a customer that wants to get qualified, have them reach out, because I'll be able to tell them what's going to work best for them, and then figure out what's going to work best for them, especially if they have a lot of student loans. I'll be honest with you, in the past, especially FHA borrowers, especially the ones that have, I'm not kidding you. I have a client right now that has a $191,000 student loan debt. So obviously FHA, you're talking about $1,900 a month.
Right.
Previously, now now with the new rules, they're at, let's say $500 or $600 a month. So everything is going to be relative with qualifying. But obviously, you have a client that wants to get qualified, please have them reach out to me, and I'll look at the programs and see what's going to work best for them.
What if their student loans are deferred? What happens then?
So in order for us not to use a student loan, it has to be deferred for at least 3 years.
Okay. So if it's deferred for at least 3 years, the debt for the student loan is not considered when you're looking to pre-qualify somebody for a mortgage.
Correct. Correct.
It's all interesting things, and definitely things I don't think people are thinking
about. VA is a little different too. I don't have that. I know that there's some rules and regulations with VA, but I can look at that if we have a client that's looking to go VA.
Okay, great. Biggest point is to talk to a bank, a mortgage company, anything along those lines, and really see where you're at financially. Credit score is so important, and looking at all of your debt, what you owe, what you have coming in, things like that. So, Laura, is there anything else that you want to add, or Anna?
Well, I just wanted to add to what you say, like trust the people that you work with, because we work here because that's our job and we work. But what I love about this field is like we build relationships, and we really want to help you. We want to make you. We want to see your success, achieve your dream, achieve your goal, whatever that is, and just trust the people that you work with.
Yep, absolutely. So, Ana, is there anything else you want to say in Spanish real quick? If there's anybody watching who is in Spanish.
Sure. Para todos los que escucharon este capítulo, llámenme, por favor. Les puedo resolver todas sus dudas acerca de créditos, cómo subir su crédito, sus puntos de crédito para alcanzar su sueño de comprar una casa o invertir, etcétera. Hablamos muchas cosas en inglés. Sin embargo, bueno, todo esto, si me contactan directamente, en mi número que está aquí abajo, podemos platicarlo personalmente. Muchas gracias.
Oh, you're echoing. There we go. I can hear you now. Sorry. Go ahead. You can finish.
No, that's it. Thank you. I finished my speech in Spanish.
Perfect. Well, Laura, thank you so much for joining us today.
Thank you.
Her information is found right on her little screen there. So if you have any questions, feel free to reach out. She's always responsive via text, email, cell phone. She's always great at getting back to people with their questions. And don't forget Olmsted Real Estate Group. We are a bilingual real estate company here to answer all of your real estate needs in English or in Espanol. So keep us in mind, and we hope that everybody has a great Monday.
Wonderful. Thank you so much for having me.
Absolutely.
Thank you, Laura.
Have a great day.
Have a good day.